So now we're going to take a look at the operating costs of a vehicle. So now we've already decided how we could possibly pay for it or obtain a new vehicle. Now we got to figure out, well, how we pay for it on an ongoing basis. Okay. So we could take a few minutes to try and figure out different costs associated with owning a vehicle. We could think along the lines of gas, tires, uh, insurance costs, repairs and maintenance, or any other number of things that go along with it. Okay, so a whole whackload of costs are associated with the vehicle. Licensing, getting spot checks done, this kind of thing. So generally when we talk about costs, we term two types of costs. One is a fixed cost, so a cost that stays the same no matter how much or how little you use it. An example of a fixed cost might be something like the cost of insurance. Okay. So if you own a vehicle and you drive it, doesn't matter if you drive it 10,000 kilometers in 1 year or 4 kilometers in 1 year, your insurance costs are basically the same. The variable costs are costs that go up or down depending on the amount that you use it. So variable costs, most obvious one is going to be gas. The more you drive, the more you spend on gas. Could be tires, okay, because the more you drive, the quicker your tires wear out. Could be maintenance, repairs, that type of thing. So there's both a combination of fixed costs and variable costs that are assigned that go along with a vehicle. Okay. So first thing that we want to talk about, we'll look at insuring a vehicle. So you have to insure the vehicle in order to be allowed to drive it legally on the road. So we'll say that Jay is 19, he owns a 7-year-old mid-sized car. The lowest insurance quote that he received was either for $2,620 per year, and so he has two payment options. He can pay either the full premium once a year, or he can make monthly payments of $230. Okay, so we want to calculate the annual cost if he chooses the monthly payments. Well, we want monthly payments. That means he's making 12 of them over the course of the year. So $230 times 12. So 230 times 12. That's going to equal $2,760. Okay, so obviously there's a higher price if you pay monthly payments instead of doing a one-time lump sum payment. So we want to figure out, well, what's the difference between the two payments? So the difference, that means subtraction. So the higher payment is the monthly payment, so $2,360 minus the lower payment of $2,620, and that's going to equal $140. Okay, so the cost difference between those two payment options is $140. So he could pay $140 less if he makes the one-time payment all at once. Okay. So what are some reasons why Jay might choose each option? Well, he might choose the lump sum, like all at once, because it's cheaper. Okay. It's cheaper, it could be easier, maybe he has the money available. The monthly payments, okay. Maybe he chooses the monthly payments because he doesn't have the money, he doesn't have all the money right away. So he needs time to make the money. Or rather, he needs time to make the payment. Either way you look at it, insurance companies will give you various options in terms of how you can and cannot afford to pay for your vehicle, or rather your vehicle insurance.